Okay, let's turn to the income statement or the profit and loss statement. The purpose of the income statement is to show managers and the investors whether the company made or lost money during the period reported. Okay, let's turn to an example of an income statement for Home Depot for December 31st, 2014. Of course, the firm's income statement measures the firm's performance over a specified period of time. Of course, like we said, this is December 31st, 2014. We have the income statement over here, and then we have, just like we did with the balance sheet, a common size income statement. Of course, all items of the income statement are expressed in a percentage of revenues. So you can see here, going from net sales, other income, cost of goods sold. All this will be used when you're doing your trend analysis for your project. Okay, let's look over here for the common size. Just as with the balance sheet, it's easier to look, see trends or patterns. You could use time periods of 2013, 2012, their competitor, there's their industry. Something that's kind of interesting here, you can see the 65.2% makes up, 65.2% is percent of revenue is taken up towards the cost of goods sold. Like I said, you can see trends or patterns using the common size statement here. And if you're interested in looking at earnings before interest and taxes, of course, this would be equal to total revenue plus other income minus cost. As we looked at the other one, cost of goods sales make up about 65.2% of revenues minus depreciation, and you can see earnings before interest and taxes is 10,8.6 million. Let's go back and see if that's the number right there. Yeah, 10,806. Of course, that's in millions. Okay, in this slide, we're looking profits versus cash flow. The income statement is going to show the profits here. Of course, profits, as you notice, if we subtract depreciation, which is a non-cash expense, profits going to ignore cash expenditures on new capital. Of course, that is going to be used where we use the depreciation. Profit records income and expense at the time of sales, not when the cash exchange actually occur. And that's where we're going to get with the cash flow here. Is going to show actually when that capital expenditure was actually paid for. Profits do not consider changes in working capital. Let's use an easy example here. I mean, this may seem confusing here. Let's say I'm in business and I purchase materials worth $1,000, and I make some product, whatever, it could be anything here, and I earned $1,200. Now, of course, you're going to take the $1,200 on the income statement. It's going to show that minus the $1,000 for the cost of goods sold. So I would have a profit of $200. But let's look at the cash flow. Let's say the materials here I purchase. Of course, it's going to be $1,000. But let's say the company that supplies those materials gives it to me where I can pay 1 month and pay the second amount in the next month. So the first month, in month 1, my expense for materials is $500. Now you notice I may not get paid in this particular example until month 2, which is the $1,200. So when we talk about being short of cash flow here, this is important. The company that provided the materials for me wants paid now, the $500. So I'm either going to have to borrow that, have that in retained earnings, whatever. So I could still be profitable, but I could go out of business due to cash flow. So anyway, so for the first month, I had a $500 cost of materials. Second month, okay, the second exchange of there, because the person or company that provided the materials for me wants the second payment of $500. But the company that I sold my particular product to is going to pay me $1,200. So that shows you the first month there was $500 of outflow. Second month, there was another $500 outflow and a $1,200 inflow for a total profit again here, looking at the cash flow side of the equation here of $200. Which now we will turn to the statement of cash flows.